We'll now hear about the Federal Student Loan Program, the U.S. Department of Education, and the presentations will be made by Mr. Leo Kornfeld and Jerry Sullivan.
Thank you. 7 million students last year took out a loan from the federal government to attend college. That makes it 6 out of every 10 persons in this country had to take out a loan from the federal government to attend college or university. The volume of that loan amounted to $32 billion. That's with a B and not with an M. As a matter of fact, the cumulative loan portfolio in this country is over $200 billion. The federal program has been around for 25 years. It's been run by thousands of lenders throughout this country. The program has repeatedly been reported the problems with it from the Government Accounting Office and other such agencies. The lenders in this country have received federal subsidies for this loan program. And the subsidies amount, as in other cases unfortunately, directly proportioned to the effectiveness of the lobbyists. The direct loan program was established approximately 3 years ago as a program, and it's the first time this program has come, a major change has come about in this program in an innovative re-engineering way. Let me cite the 5 major innovations of this program. First, this program is software has developed for this program, so it is completely paperless. No longer do the persons who have to borrow money from the federal government have to fill out these elaborate, comprehensive forms. Secondly, the program is cost effective. Unlike the federal subsidies, what we have done in this program, we have partnered with private industries who have to compete to partner with us, and they operate the program for us. Also, this is one of the few major federal government programs in the billions that can account for every single penny that has been distributed, as certified by an outside CPA firm. The third, customer service. This program was developed by working with the customers, the persons who are going to have to live with these programs and borrow the money and repay these dollars. Program was designed so no more long lines for students. Students getting the money when they need it to pay their rent and buy their books. No longer frustrating busy calls. So a computer system was designed so as soon as the busy signals in a phone system go up to a certain percentage, more telephone lines are installed. Fourthly, it's choice. Institutions can decide for themselves whether they want to participate in their program. No longer federal regulations that say thou shall. If a school, an institution wants to participate, they can do so. If they want to leave, they can do so. It's their choice. And fifthly, and perhaps most important, a repayment program where the student pays based on their financial capability and tied into the IRS, where each year we determine the student's affordability and how much the student has to pay each month. The program has already been replicated is being planned to be replicated in many other ways: the origination, the accountability, and a repayment. With me, I have Jerry Sullivan, who is from the University of Colorado, which was one of the first schools to implement this direct loan program. And I should also add that Kennedy School has also been one of the first schools to select this program.
At the University of Colorado, approximately 14,000 students every year borrow about $70 million to finance their education. It's been a process up until recently that's been marked by delay, complexity, confusion, frustration. Direct loans has changed that. It has provided an improved product. There are more flexible terms and repayment, which are able to customize individual terms to individual students. There's standard information provided to each student on the level of debt that they're achieving, and that's been given routinely and repetitively. Both of those points should cut down on default. Improved service. The old program, it took about 4 to 6 weeks to obtain a loan. The new program, direct loans, 24 hours. Reduced costs. Loan fees first. 8% reduced to 4% based upon savings federally because of the direct loan program. There are fewer agencies, and as a result, fewer questions to universities' officials. Improved technology has resulted in improved cash management at the local campus. Student satisfaction has been high. Surveys been used to measure that. Focus groups, independent student leaders have approached us asking us, how can we help convince Congress not to cap direct loans? Reduce borrowing, a surprise outcome. The process has been so simple. Students borrow what they need, not what they're eligible for, realizing that they can come back and in 24 hours increase it if they have to. All of this been verified through an independent state performance audit in November of '95 at the University of Colorado. There's a variety of innovative things that the department did, but the most important was that rather than saying take it or leave it like so many other programs, they've said let's create a partnership and build this thing together. And it started with negotiated rulemaking. We built the rules together that run this program. There was an emphasis upon quality management. There was an emphasis upon transferring the business process between both of us, all of which worked out very well. Finally, we are given a choice. If we don't like it, we can go back to the other program.
Right on time.
That's it. We planned it that way.
If we have questions from, starting with David.
I'd like to ask you to respond to some of the concerns that have been raised in Congress. As you know, there are those who believe very strongly in what you're doing. There are others who believe that a more private-oriented, guaranteed loan program actually ought to be given a real chance too. The argument that they're making, the Chronicle of Higher Education had a piece earlier this year outlining some of the concerns of people who believe in the private sector approach. And they say basically, you've created a program in the direct student loan that's very streamlined, it's very easy for the students to use, very easy for the universities to use, it's better for everybody, but you've loaded up the guaranteed student loan program with so many restrictions that they can't compete, that in effect you've created a bias toward this program and made the private sector approach very difficult for students and for universities.
That has come about, and that usually gets called a level playing field. And
Right.
The statement and the criticisms are really not valid. We have bent over backwards to try to improve the guaranteed loan program in the same way we can. And what we have tried over and over again to change the regulations, we meet with the representatives of the lending industry in this country, find out what their major concerns are, and we're trying very hard to level the playing field. The kind of things they have, as in all competition, and that's what this is boiling down to, they have certain advantages, we have certain advantages. For example, they can lower the interest rate to students if they choose to do so. They choose not to do so. We, by law, must keep the interest rate at a certain level. They can make all kinds of flexible changes. They could do things which we cannot do. We have to follow the laws that Congress has passed. So there are certain advantages they have. In my opinion, much of the criticism, although there's some that is true, but much of the criticism that the guarantee agencies and the banks in this country have submitted is primarily because of survival. The schools want this program. The 500 presidents of the major universities of this country signed a petition to Congress saying, do not cap this program. The student associations marched on Washington to prevent Congress from capping and eliminating this program because it was so desirable to them.
And their argument is that the law sets a rate for the guaranteed program which is higher. The interest rate's higher, it's 9%, whereas you can go down to 8.25.
No, that's not correct, Mr. Gergen. The interest rate that all students pay, whether it's a guaranteed student loan program, direct loan program, is 8.25%. That's in the law. Everyone must pay back.
Can I ask you one final question? That is,
Sure.
who winds up in the direct student loan? If the case there's default in a guaranteed program, the bank is the first defender on that. Under this direct student loan approach, who winds up paying the default?
In all the programs, the person who pays the bill is the federal government. The banks, when a person defaults, the bank sends it to a guarantee agency. The guarantee agency sends it to the federal government. The federal government pays off the loan, and the guarantee agency pays off the bank. Mm-hmm. The difference, however, will be in the direct loan program, we foresee a reduction in the default rate by about 50%. The default rate in this country last year was 11.6%. It cost the taxpayers in this country $2.5 billion. We anticipate and we're projecting the default rate in the direct loan program, because of the way we're handling it, the way we're counseling students, the way we're working with students, the way we're billing students, will be down to about 5%, which, by the way, is the exact same percentage that the credit card default rate is in this country.
Other, yes, Tom? And
The
then
changes
Louise.
that have been brought about, how many of them are pursuant to changes in the law, and how many of them were regulatorily inspired by the agency?
By the way, although it's, in the last few years, this has been a very partisan effort. It's the Republicans versus the Democrats, as you all know, if you read any newspaper in this country. But the truth to tell, this program was started by Mr. Bush and not by Mr. Clinton. So it's sort of interesting. The law is sort of very broad. The law just describes where the funds are going to come from. The law describes the interest rate. The law describes choice and not mandatory. Most of the program has been designed internally, working, as Jerry pointed out, working with the institutions and the students of this country.
Louise?
Can you explain the subsidy that was eliminated?
Subsidies in the federal program are very interesting. For example, the banks in this country get it's a formula passed by Congress, which gets the banks in this country something in the order of magnitude of 9% for a guaranteed loan, the best deal on Wall Street. In addition to that, the guarantee agencies, which are another player in this program, get money when the student becomes a defaulter. So the way the old program was even motivated in the wrong direction. What happened if they did not get that student to pay the loan back? If they got that student to pay the loan back, let me say it that way, they got nothing. But if they classified the person as a defaulter, they collected 27% off the top, and they gave the federal government 83% of the amount they collected. Last year alone, the guarantee agencies collected something in the order of magnitude of $1.2 billion after the person was classified as a defaulter. Secondly, the paper is sold back and forth. Banks sell it to other banks sell it to secondary markets. The Treasury Department has reported that the secondary market, which uses tax-free bonds, which cost the taxpayers in this country over $2 billion because of the buying and selling of that paper portfolio.
The time is just up. You've